Hey everyone, welcome back to the channel. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Today I want to talk directly to those of you who have been long-term believers in SCHD or maybe recently added it to your portfolio because you wanted something stable and reliable. SCHD has earned its reputation as one of the most dependable dividend-focused ETFs on the market, and for years it did exactly what investors hoped it would do: deliver steady growth, provide solid income, and stay resilient during choppy market periods. However, if you've been watching its performance recently, especially over the past year or two, you've probably noticed that SCHD hasn't really kept up with the broader market. In fact, it has underperformed compared to some of the flashier, tech-heavy ETFs or indexes that have been boosted by the massive wave of enthusiasm surrounding artificial intelligence and large technology companies. And I get it. When something you trust starts underperforming, it's easy to start questioning it. But SCHD isn't built to outperform when everything is booming. SCHD is built to hold strong when things get messy, when interest rates start shifting aggressively, when economic uncertainty rises, and when the market begins to rotate from growth into value. And we have not had that type of environments recently. What we've had instead is a market dominated by excitement and speculation around tech innovation and AI expansion, which means value-based strategies have taken a backseat temporarily. But the key word here is temporarily, because as cycles rotate, and they always do, the performance dynamics shift. So it's not that SCHD is no longer good, it's that the environment hasn't been one where its strengths are rewarded. However, what I want to introduce today is not a replacement for SCHD, but an ETF that works extremely well alongside it, especially if you want to balance value exposure more broadly. The ETF I'm talking about is VTV, the Vanguard Value ETF. Now, both SCHD and VTV fit into the value side of the portfolio, but they do it differently. SCHD selects companies with strong, reliable, and growing dividends. It focuses on financial quality and sustainability of income. VTV, on the other hand, simply screens for large companies that appear undervalued relative to fundamentals, regardless of whether those companies pay high dividends or not. So SCHD is value plus dividend quality screening, while VTV is broad value exposure without dividend requirements. That's actually an incredibly important difference. Because VTV holds over 300 companies, you're getting a much wider range of value stocks across the large cap space. SCHD, in contrast, holds around 100 companies because it applies stricter screening criteria. So if you want a wide net, VTV is the one casting it. If you want tighter, quality-focused selection, SCHD is the curated portfolio. Another key distinction between the two is dividend yield. SCHD typically provides a significantly higher yield, somewhere around 3.5% to 4%, depending on conditions, while VTV sits closer to around 2% or a little above. So if your investing strategy involves generating income or building a passive cash flow stream, whether for retirement or lifestyle reasons, SCHD plays that role more effectively. But if you care more about broad exposure to undervalued companies and potentially smoother performance swings due to diversification, VTV may complement SCHD well. The sector breakdowns also tell an interesting story. VTV leans heavily into financials, healthcare, industrials, and energy, with relatively low exposure to technology, which is intentional because it is a value ETF. SCHD, while also light on tech, leans more into consumer staples, healthcare, energy, and defensive industries, companies that tend to hold up when economic pressure rises. And if you compare the top holdings, they don't overlap as much as you might expect. VTV features names like JP Morgan, Berkshire Hathaway, Exxon, Johnson & Johnson, and Walmart, companies associated with industrial and financial leadership. SCHD features companies like Pepsi, Coca-Cola, Merck, Cisco, Amgen, Lockheed Martin, and AbbVie, companies associated with stable cash flows and strong dividend growth potential. So what that means is that holding both ETFs actually increases diversification rather than creating redundancy. Now let's talk performance, because this is where emotions tend to come in. Recently, VTV has outperformed SCHD in the short term. That's mainly because financials and industrials have been performing relatively well, while dividend-focused strategies have lagged. But if you zoom out and compare performance over longer time horizons, 5, 10, or more years, SCHD and VTV actually come much closer to each other, with SCHD often pulling ahead during periods when interest rates fall and when investors seek safety and stability. Long-term investing is not about who runs fastest during a sprint. It's about who maintains strength across the entire marathon. SCHD's underperformance isn't structural, it's environmental, and environments change. So how do you decide which one to invest in? It comes down to your goals. If you want strong income, reliable dividends, and exposure to companies that consistently return profits to shareholders, SCHD remains a strong option. If you want broad value exposure, diversification, and a smoother balance across many sectors, VTV is an excellent complement. And here's the key idea: you don't need to choose one and reject the other. Using both together can create a stronger, more resilient value allocation. VTV provides wide value exposure. SCHD provides high-quality, income-generating holdings. Together, they cover different angles of the value landscape. There's also a tax consideration. Because SCHD pays higher dividends, if you hold it in a taxable brokerage account, you'll owe taxes on those dividends each year. By contrast, VTV has a lower yield, meaning less tax drag in taxable accounts. So, in many cases, investors may place VTV in a brokerage account and SCHD inside a retirement account, such as a Roth IRA or traditional IRA. That way, SCHD's dividend income compounds tax-free or tax-deferred. It's not mandatory to structure it that way, but it is efficient. Now let's zoom out and think strategically about timing. Right now, a lot of attention is still going into technology and AI-driven companies, but hype cycles do not last forever. When growth slows, when investors become more cautious, or when interest rates come down and capital flows begin to rotate, value stocks, especially high-quality dividend-paying value stocks, tend to strengthen. SCHD is positioned extremely well for that moment, and VTV can help smooth the path while still keeping your portfolio aligned with the value thesis. Instead of abandoning SCHD because it's temporarily lagging, think of reinforcing the structure of your value exposure. Think of strategy, not reaction. SCHD hasn't stopped being good. The environment just hasn't been the one where it shines. VTV is not a replacement, but a complement. SCHD is value plus high-quality dividends. VTV is broad diversified value. Together, they form a more complete value allocation that can increase stability, diversify holdings, and strengthen long-term performance potential. And when market cycles rotate and growth enthusiasm cools, dividend strategies and value resilience have a strong chance of regaining momentum. The key is not emotional timing, it's intelligent positioning. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.